Okay, next get started about the capital rationing. So capital rationing, what is it? Capital rationing refers to a situation where the firm's finance is limited. Okay, because money is scarce, it's not unlimited. Okay, this is a limited resources. So the company has to have a control in the investment in all positive NPV projects. Okay, it doesn't mean the company doesn't invest in any NPV projects, but it has to make choice between different NPV projects. Because in I think when you go through our first class, in the first class, we talk about the NPV projects. We talk about what is mutually exclusive projects. So for mutually exclusive projects, we don't, for example, for NPV and IRR, we seldom use IRR because it is weak in making the decision for mutually exclusive projects. Okay, I hope you understand or you remember the reason why. Because for IRR, one of the major assumptions is the reinvestment rate of return. Okay, assume all cash flow generated from the projects will be reinvested at the same rate of return, but it is not sensible. Okay, for a company, it has the cost of capital, which means it's the required rate of return by the investors, including both debt holders and equity holders. So the cash flow generated from the project should be reinvested at the same required rate of return that applied for, given the risk level is the same. So it's the problem of IR. So coming back to capital rationing. Capital rationing, we discussed about how to allocate the funds into different projects. Okay, into different projects. So it can make the highest, suppose it can make the highest net present value to the company in which the shareholder wealth can be created. And there are two reasons for capital rationing. First of all, okay, we'll talk about hard capital rationing or the external capital rationing. So what's the reasons for hard capital rationing? First of all, inability to borrow. Just one very simple example is the company borrowing money from the bank, or its repayment record is not that good. For example, it cannot meet the schedule by the bank to repay the debts or the interest. So the bank unwilling to lend to those companies with poor past performance or lack of asset backing. In a lot of countries, the banks, when the bank lends you the money, the banks will ask you any asset backing for the money you borrowed. Okay, it's very important because the bank is making business, should make profit. In case of the risk management point of view, in case if there's any defaults, they should have some asset back for those money lent to you. Okay, so if you have no asset backing, then it's quite difficult for the bank to lend you money. Also, if the interest rate is too high, for example, in the financial crisis, like in 2008, the Lehman Brothers, one of the big investment bank in US, it just closed overnight. Then all the banks or all the financial institutions are scary. At that point in time, they were scary and they don't want to lend money to any potential borrowers or potential customers. So they would like to stop any lending business. Then it will push up the interest rate in the market because the supply of money is the supply of funds from the banks suddenly slowing down. Then the demand for the funds will push up the interest rate. It's very difficult to borrow money when the interest rate is too high in those financial crisis case. And also government policies. For example, some governments, okay, some countries, they would like to have some restrictions on the lending business because they would like they found there's a bubble for example in the property market. They would like to protect the financial industry, so they will restrict the lending business by the bank to ensure the banking system or the financial system in the country is in a good shape. All these factors is affecting the company's ability to borrow. The next point is about the shareholders. In this case, for example, if a listed company, maybe it listed in Singapore, in London, in Hong Kong, in New York, or in any financial markets, when market situation is not good or the shareholders are not very confident about the company's prospects or the future, then it is difficult for the company to raise new capital from the shareholders, no matter it's the existing shareholders or the new shareholders. Especially when the company would like to, for example, to have a rights issue. We'll talk it about in the sources finance when we go through this topic. It's very difficult for the company to issue new shares in this case. For those shareholders are not confident about the company's future, or there's no business or new projects that need to be invested, only the new money is helping the company to survive. Okay, it's quite hard for the shareholders to subscribe the new shares and give the money to the company for operation. And the next reason for capital rationing is soft capital rationing or some internal factors. What we just talked about is the external factors. We talk about the bank, they don't want to borrow to lend you money. We talk about the government. We talk about the market interest rate is too high. We talk about the shareholders. It's all external parties. Okay, we talk about internal parties. It means the within the company. What factors within the company leading the company need to consider capital rationing? For example, lack of good advanced planning results in certain shortage of fund. In general, okay, I just brief you in general case. A company should have a treasury department, okay? It plans for the funds flow, no matter it's cash inflow or cash outflow. For the inflow, maybe the collection from the customers. For the outflow, maybe it is the payment for the salaries to the suppliers of goods or materials. So it should have a treasury department to manage the cash inflow and outflow to make sure the company has sufficient funds for operation or for the investment planned. But in some case, they have no or they're weak in cash flow planning. So in some case, there's some shortage of fund. Okay, in this case, maybe lasts for 6 months or 1 year. It cannot borrow from the external parties. It doesn't. The business itself doesn't generate a lot of cash flow to support the investment projects. Then the fund shortage will lead to another consideration. Okay, maybe the fund is very limited right now. We should have 3 million, but right now it's only have 1 million. In this case, the company has to consider capital rationing. And company policy on cash limits is about internal policy. I think these 2 points, okay, the first point, lack of good advanced planning, and the company policy are linked together. The company policy and cash limits, okay, if the company policy is already in place, then the treasury department, for example, should plan well before. If it is expected that investment project is asking for money, okay. So I think these 2 items should well link together. But if the company has a policy in place on cash limits, it may mean that the management would like, for example, the other one case is, for example, the company would like to have a policy on each individual projects the cash limits on each individual project. So they don't want to too much money or too much cash injected into only one project. So two types of capital rationing. Single period rationing. Okay. It means there's only one period, for example, 1 year. The other is multi-period rationing, maybe, for example, 2, 3, or 4 years, or even more, or even longer. But it is divided into different stage. I can say different stage. In ACCA F9 examination, okay, we only concern about single period capital rationing. So don't worry about the multi-period rationing.